Hello everyone, thanks for checking out my video. The S&P 500 climbed higher last Friday, ending 4 consecutive weeks of declines that were brought on by trade policy uncertainties and recession fears. Technology stocks, initially the biggest drag on the market, rebounded and helped to offset a significant portion of the losses across the stock market. This latest rally was likely driven by President Trump's statement that he would maintain flexibility regarding the reciprocal tariffs that are set to take effect in less than 2 weeks. However, the Wall Street's biggest challenge in recent weeks is that any attempted rally had largely failed due to the ongoing uncertainty and confusion surrounding Trump's trade policies. In this video, I will cover more about the implications of tariff uncertainties and also review the stock that I bought last week. So as always, stay tuned until the end to get all the details. A quick recap: the S&P 500 squeezed out slight gain last Friday, erasing earlier losses after comments from US President Trump provided hope that previously announced tariffs, which are expected to begin in early April, may not be as bad as feared. While speaking to reporters at the Oval Office on Friday, President Trump said that there would be some flexibility when it comes to reciprocal tariffs. The market appeared to react positively with some relief rally in the final hour of the trading session. All three indexes ended the week in the green. However, most of last week's gains actually came from the rally followed the Federal Reserve's decision on Wednesday. What happened on that day was that the central bank had kept interest rates unchanged and signaled 2 rate cuts this year, which is in line with market expectations. In addition, in a rare occasion, Fed Chairman Jerome Powell also reassured investors that the economic impact of Trump's trade war seemed manageable, and he also added that recession risks remain low. The funny and interesting thing is that Powell used a once abandoned term to describe the inflationary impact of tariffs. He said it is likely to be transitory, which was surprising to analysts. In case you are not aware, the word transitory was previously used by Powell to describe the pandemic-driven inflation, and we all know that didn't age well as inflation remains sky-high till today. The Wall Street has been mocking this term for a while, and I was surprised that Powell revived it back. Anyways, sorry I digressed. Just to add, there were some negative news that came out from the Fed meeting too, which included forecasts for higher inflation and lower economic growth. These are the two concerns that have deeply rattled the markets in the recent 2 months. This was probably why the rally couldn't sustain one day after the Fed meeting. Meanwhile, I thought it's worth mentioning that last Friday's session also marked the expiry of quarterly derivatives contracts tied to stocks, index options, and futures, also known as triple witching day or quadruple witching day. Okay, I don't want to go into the details of the terms, but essentially and typically on such a day, there is a spike in trading activity as investors close out their positions. The market volatility is usually on the higher side, and price movements can be sudden and choppy. According to Goldman Sachs, close to $5 trillion of options exposure was set to expire last Friday. My point here is, we really don't know whether the end of the day rally on last Friday was a result of traders adjusting their positions. Therefore, don't be too excited about the market surge yet. Do check out my technical analysis segment later to find out what we should look out for in the upcoming week. Okay, in terms of market outlook, the developments around tariffs and its related headlines will continue to unsettle the market this week as we get closer to early April. On the economic front, there are several data and reports coming up, which include the Purchasing Managers Index, Consumer Sentiment Survey, Consumer Confidence, GDP, and most important of all, the Federal Reserve's Preferred Inflation Gauge, the PCE data. All these data points will be crucial in determining the current state of the consumer and whether the new trade policies have shown any inflationary effects at this point. In terms of earnings, some notable and retail favorite companies will be reporting their quarterly performances this week, such as Lululemon, GameStop, BYD, Lucid, and Haidilao. Let's now move over to the technical analysis section. As always, we will begin things off with the broader market SPY. SPY is displaying a few bullish signals, but before you get too excited, I must say I remain very cautious about these signals. Let's break it down. First and foremost, the MACD had a bullish cross last Friday. Secondly, SPY has closed above that blue resistance line that I drew, as well as the first Fibonacci retracement level at around 563. Sounds not bad, right? Okay, here comes the problems. First up, SPY tested the 200 moving average on 4 occasions over the last 2 weeks but could not close above it. This shows that each time when the bulls brought the price up during intraday, the bears managed to push it down by the end of the trading sessions. Next, if I were to zoom out the chart, you can see that there is a potential bear flag pattern forming. Watch this pattern very closely, because if it gets materialized, I'm not kidding you, the downside could be massive. The recent low of 548 can be breached easily, which means SPY will fall back into the correction territory. In summary, watch this potential bear flag and the 200 moving average like a hawk in the next 2 weeks. For SPY to regain its bullish momentum, it really needs to get above the 200 moving average soon. Otherwise, the overall market remains bearish and we could experience another wave of sell-off. All in all, I do urge everyone to pay special attention to SPY or SPX these 2 weeks to have a sense of the overall market direction. Moving over to Apple, if you could recall, in my last video, I talked about this bullish harami candlestick pattern and how to look for confirmation. Well, the confirmation came last Monday with that green candle and Apple rose more than 2% last week. In case you are not aware, given how big its market cap, a 2% rise in Apple's share price is quite significant. It's actually more than $65 billion, which is more than the market cap of General Motors or around the size of PayPal and Dell Technologies. Anyway, if you have benefited from my last week's analysis, do give this video a thumbs up. Alright, so what's next? Let's zoom out the chart and you probably can see something similar to SPY's chart. Yes, a potential bear flag. If this bear flag does play out, we will likely test that green support line and potentially break below it. This green line is around 206. If Apple does lose this 206 level, I'm not kidding you, we will very highly likely see Apple in the 190s range simply because there isn't much support below 206, and that fits the profile of a bear flag, because in the bear flag breakdown, the movement is usually violent and huge. But of course, nothing is guaranteed in the stock market and not all bear flags will play out. To invalidate this potential bear flag pattern, very simple, get above the 38.2 Fibonacci level at least. That level is 224. For Apple to completely shake off this bear flag and regain its bullish momentum, it's even more straightforward, which is to go above 229. Because by doing so, it means Apple is trading above the important 200 moving average and above the potential rejection point at the 50% Fibonacci level. Let's now jump over to Tesla's chart. Tesla clocked a 9th straight weekly loss, which is its longest losing streak in history. However, the share price popped more than 5% last Friday, outperforming the other Magnificent 7 stocks. In addition, the MACD had its first bullish cross since 3 months ago. So, has Tesla finally stopped its rot, or will we see a 10 consecutive loss this coming week? Okay, to answer these questions, there are a few things to watch out. First up, watch that green zone that I drew. This area has turned into a resistance zone and its range is around 264 to 272. But then, given how volatile Tesla is, I will stretch this watch area to 284 where the 200 moving average is. In short, for Tesla to temporarily stop its rot, it needs to at least reclaim the 200 moving average. By going above the 200 moving average, it also means the share price would have gone above the first Fibonacci retracement level at 281. From there, if Tesla can gain some footing at the 280s range, continues to hold above the 200 moving average, then I do see a potential upside towards the 300 level. Here's one potential good news for the bulls. A look at the weekly chart shows that we have 2 bullish hammer candlesticks. For confirmation, we need the next weekly candle to close above the high of the last hammer candlestick, which means above 249. On the other hand, a very quick one, if you would like to support this channel and are looking for a new low-cost brokerage, do consider Longbridge. To be honest, I do earn some referral fees if you sign up using my referral link and deposit at least 2,000 Singapore dollars. If you want to get a free Nvidia share, you will have to maintain that $2,000 for 30 days and make 3 separate buy trades. Check out their website for more information. Alright, going back to the chart. On the other hand, if you had realized since falling from its peak, every pop in Tesla share price has been met by sellers stepping in. This is why even with last Friday's 5% surge, I remain very cautious, because it could be a short the pop scenario again, which means Tesla could bounce from here, trap the boost before the next sell-off. And I'm not trying to scare you here, but if Tesla gets rejected at either the green resistance zone or the 200 moving average, I do think the share price could drop towards the low 200s range, which means breaking below the recent low of 217. And then if we ever go below 200 in the next few weeks, all hell will break loose. Because below 200, I do think the probability of the share price filling that gap is high. The gap is in the 140s and 150s range. Just one last thing to share, similar to SPY and Apple, there seems to be a potential bear flag pattern forming on the chart. So you might want to watch this closely as well. To reiterate again, if a bear flag materializes, the downside can be massive. Next up, Google. Google's chart looks interesting. I mean, look at how it has been testing this green support zone that I drew. The range is between 160 and 162. In fact, we had a brief scare last week when Google broke below it during intraday, but the boost managed to bring the share price up by the end of the trading session. This basically shows how strong this support zone is, but it also means if it breaks, it could be a waterfall moment. So let's say if Google starts closing below this support zone, I do think there is a high probability for Google to fill the first two gaps. In other words, it could go as low as 151. And if we do reach this 151 level, that's more than 25% discount in its share price from the peak of 206. At low 150s or sub 150s range, pay very special attention to the low created in September last year, which is around 146. If that breaks, I do think we can say hello to the third gap between 142 and 145. Sorry, I know that sounds kind of obvious. Okay, on the other hand, if Google continues to hold above this green support zone and begins its rebound, I am expecting the share price to close the top gap between 168 and 170. This is also where the 23.6 Fibonacci level is, which means it's a double resistance area and therefore watch for potential rejection. If we do get a rejection here, then we could see another leg down. Okay, but if somehow Google can print a few nice candles above 170, then there is a decent probability for Google to test the 200 moving average at around 175. From here, if Google can reclaim this moving average, it's pretty bullish in my opinion. Anyway, as shared last week, the time is ticking for Google to reclaim this ever important 200 moving average. Just to add, a rejection at the 200 moving average is very bearish in my opinion. And also, the longer Google stays below it, the more bearish it is, and the higher chance for us to see 150s range again. Let's now have a look at Meta's chart. Meta is on this very neat and nice downtrend as it created a series of lower highs since hitting its peak at 740. So for Meta to have some possibility of reversal of this downtrend, it needs to stop creating lower highs and then start creating higher highs. In other words, Meta has to get above that green zone as well as the first Fibonacci level at around 614. When that happens, then it gives us some possibility of a reversal of this downtrend. But honestly, for Meta to be caught bullish, we need the MACD to have a sustainable bullish cross and the share price to reclaim the 50 moving average at around 652. Actually, I should stretch it to 657 where the 50% Fibonacci resistance level is. If somehow Meta can go above this 652 to 657 area, the share price could fly another 20 points at least. Just one more thing to add, among the mega cap stocks, Meta is the only one that is still trading above the 200 moving average. And the share price went close to it last week, but buyers stepped in even before it touched the moving average. That's a good sign. And for information, I was one of the buyers. If you could recall in my last video, I was questioning if I had missed the opportunity to buy the dip when it bounced up previously. Well, I guess I didn't. Anyway, in terms of the downside, I think for now we just have to pay attention to the 200 moving average at around 572. If this level breaks, then just like the other Mag 7 stocks, the share price will likely continue to drop further, probably towards the 550s range. In fact, I won't be surprised if it touched the second green support zone at 540s range. So yup, the bulls have to protect the 200 moving average at all costs to prevent a big downside. Moving over to Microsoft. Microsoft's chart looks boring, straightforward, and a little weak to me. Remember these three words, okay? Boring, straightforward, and weak. I will just use these three terms to analyze the chart. First up, as you can see, the share price has been moving sideways for the last 2 weeks without any wow or violent movements. That's boring. Next, the share price has been flirting with the very important 385 level over the past 11 trading days. This means the bears and the bulls are having a tug of war without any clear winner yet. This makes things straightforward because a breakout above 385 is bullish, while a breakdown below 385 is bearish. Finally, the price action looks weak because despite the bullish cross on the MACD, the price is struggling to break above 385. It couldn't even go close to the green resistance line at around 396. Short and sweet, right, the analysis? That's because there's really nothing much to share about the chart as the price is in the mini consolidation mode. Let's see if we have a larger and clearer movement by the end of this coming week. Okay, last but definitely not the least, let's check out Nvidia. Well, to be very honest with you, the chart doesn't look that great. Reason being, despite having a bullish cross on the MACD last week, the push towards the upside looks a little weak as the share price went near the 50% Fibonacci level and got rejected. In case you're not aware, the 50% Fibonacci level is a resistance level where stock typically gets rejected if the short-term main trend is still intact. In this case, the near-term trend is down, which means there is a likelihood that Nvidia could fall further from the current price point of 117. More importantly, we had the kiss of death last week, with the 50 moving average crossing below the 200 moving average, which is commonly known as the death cross. As mentioned in my last video, some may say that moving averages are lagging indicators. But that being said, it does speak volume about how bearish the short-term trend is. And a lot of times, when the death cross happens, the share price remains beaten down for a while more. So if the bearish momentum continues this week, I would expect Nvidia to fill the tiny gap at 112 easily. We might potentially see a reversal in the MACD, followed by a drop in share price towards the downtrend channel. That's when I will see if the price continues to fall into the downtrend channel or will it bounce off the channel. Okay, but what if I am wrong, and what if there is suddenly some positive catalyst that drives the share price higher? How do we look for bullish confirmation? So first of all, Nvidia needs to go above the 50% Fibonacci level at around 124. That's the very first baby step to regain a bit of bullish momentum. But for Nvidia's share price to really fly, we need to close above 128 at least. By doing so, it means Nvidia is trading above the key 250 moving averages as well as the critical 61.8 Fibonacci level. When this happens, Nvidia will be in the 130s range before you knew it. Moving on, let's check out my options trades. This section should be a short one as I did not open any new trades last week. But still, I have these two trades to update. Okay, the first one is this cash secure put on Tesla with a strike price of 272.5. Just a recap, this trade originally had a strike price of 300, set to expire in February. But I have wrote down the strike price to 272.5 and the contract was supposed to expire last Friday. But as you can see, Tesla's share price has been pretty weak, and it was kind of obvious that it wouldn't close above 272.5 last Friday, and therefore I decided to roll it early on 17 March, Monday. I managed to roll the contract with a credit and brought down the strike price to 260. The new expiration date is 25th April. Let's see where Tesla's price is again in late April. By the way, in case you don't know what's rolling an option, please feel free to check out my video link at the top, it's beginner friendly. Alright, next trade is this cash secure put on Google that I got assigned. Yes, you heard it correctly, I got assigned with 100 shares of Google at 175 per share, which cost me $17,500 US. I gotta be very honest with you, if given a choice, I would have wrote this contract too. So here's what happened. On Tuesday 18 March, I wanted to roll this Google contract because it was deep in the money, but the market was falling and I couldn't roll for a good credit. Therefore, I decided to head to bed as I thought the contract could hold out for another day. But lo and behold, the very next day on 19 March Wednesday, the contract was assigned to me. So what's the lesson learned here? Well, when a contract is very deep in the money with no extrinsic value and near expiration date, it's better to roll it as soon as possible. The contract was just about 3 days away from expiration, and yet I didn't roll it quick enough. Alright, so what's next? Before that, to clarify, Google is a good company that I don't mind holding on to, just that I have already got a big position for this stock, and therefore, ideally and preferably, I would want to get the shares below the strike price of 175. Anyway, my plan now is to sell covered call against these 100 shares to earn some premiums. I didn't do that immediately after the assignment because I was waiting for a better opportunity to sell the call with better premiums. Alright, sharing some quick thoughts on the market. First of all, Wall Street has attempted several rounds of rally driven by encouraging inflation data and the dovish Federal Reserve Chairman Jerome Powell. However, the ongoing trade war continues to create volatility and limit any sustained upside. It's clear that the market is in a hesitant phase right now, with so many uncertainties still ahead, especially the 2nd April's reciprocal tariff announcement. A number of companies have indicated that they are feeling the negative effects of tariff-related uncertainty, which had in turn negatively affected their stock performances. For instance, just last week, FedEx and Nike saw their stocks plunge as investors reacted to their comments about the economic outlook. Basically, FedEx revised its 2025 forecast downward, while Nike expressed concerns about an uncertain macroeconomic backdrop. Just to add, companies are also citing confusion and uncertainty around their overall planning, capital spending, and hiring decisions. When businesses pause their hiring and cut back on their spending, economic growth weakens, fewer jobs are created, and overall market sentiment will deteriorate. At this point, there's just so much from the economic standpoint that is unknown. Don't forget, the stock market dislikes uncertainties and unknowns. They want and need clarity. Without it, any relief rally is unlikely to be sustainable. In fact, even after 2nd April, we probably still won't fully understand the secondary or long-term effects of all these tariffs on the US and global economy. Additionally, from an inflation standpoint, it is also unclear whether these tariffs will be a one-time hit to inflation. Actually, even Powell and the Federal Reserve don't have an answer right now, as they are also adopting a wait-and-see approach. Well, I guess at the moment, the one and only certainty we have is that the market volatility could remain elevated throughout the entire year, or at least until the end of first half of 2025. Meanwhile, despite the stock market rebounding from oversold levels, I believe the upside will likely remain limited for the next 2 to 3 weeks. In addition, the possibility of further downside risk should not be ignored. That being said, if investors were to look beyond the short-term turbulence, as in look beyond this year, I believe the overall environment may still be favorable for the remainder of Trump's administration. This could be a short-term pain, long-term gain strategy by President Trump. He and his team could be front-loading these controversial policies early in his term, negotiate terms that are favorable to US and its economy in the long run, and allowing time for recovery and economic stabilization. I mean, after all, Trump is still a businessman. His goal as a president has always been to make America great again, and therefore, a weak US economy throughout his administration would contradict both of his identities as a businessman and as a president. Okay, all these are just my opinions, alright, not financial advice, and I could be very wrong. To add on, this perspective of mine also excludes the possibility of any black swan events. I mean, by definition, black swan events are unpredictable. An unexpected negative event will invalidate any bullish thesis, as it will shock and disrupt the stock market, triggering a sell-off. One last thing, in case you skipped the technical analysis segment, just wanted to share that I stepped in for Meta last week. Alright, that's all for this video. Don't forget to help to like this video and comment something below to help boost the YouTube algorithm. Thank you.